ARM dropped 8.1%, and everyone is panicking. Sellers remain fixated on declining revenue out of China, completely ignoring the structural hardware transition taking place. ARM's higher-margin V9 architecture royalty engine already generates enough expansion to comfortably outpace those regional revenue losses. The Moat score is 88 out of 100, high durability. Here's what the business evidence says. What operating evidence matters most for ARM Holdings plc? ARM's royalty engine already outpaces China's loss, not despite it. And another question, what could weaken ARM Holdings plc's Moat durability? The lab sees structural pressure building on the royalty model. ARM Holdings dropped 8.14% to $260.01 last Friday. Look away now, and you'll miss why ARM's Silicon Edge still beats the market panic. ARM posted an EPS that matched the reported estimate, keeping its four-quarter beat streak alive with an average surprise of 5.1%. Wall Street reacted aggressively, selling shares over valuation alarms ahead of the July earnings release. While broad markets softened, capital rotated out of premium intellectual property valuations, treating the earnings outperformance as a temporary ceiling rather than a sustainable launchpad. The physical reality of server architecture challenges this market panic. Hyperscalers are rapidly swapping x86 architectures for custom ARM9 silicon to optimize performance per watt limits in dense AI server racks. While traditional x86 server processors hit severe thermal design power ceilings in the typical high-watt range, ARM9 cores achieve identical throughput at lower thermal footprints. ARM9 cores deliver identical throughput at lower thermal footprints, proving engineering adoption remains intact despite valuation compression. That's the real edge the market is ignoring. Now let's see how this translates to the next earnings call. Quarterly financials showing modest revenue momentum for ARM. Macro forces are accelerating this friction. With the Federal Reserve maintaining the policy interest rate at 3.63% and the yield spread normalizing at plus 0.34%, cost of capital pressures are forcing enterprise customers to scrutinize upfront software and IP capex. Capital expenditures, the funds spent to acquire or maintain physical building assets and foundational technical infrastructure. Meanwhile, third-party prediction markets place 10-year yield curve recession risk at a notable level, reinforcing a conservative spending environment. On the policy front, trade friction and potential new tariff structures threaten supply chain margins. Geopolitical exposure creates a major structural headwind that Wall Street frequently miscalculates. U.S. Commerce Department export controls explicitly prevent ARM from licensing high-performance Neoverse V2 and V3 CPU cores to key Chinese customers like Alibaba, restricting revenue expansion in major international markets. Despite these macro pressures, rapid adoption of ARM9 architecture in flagship consumer electronics like the Apple iPhone 16 and Copilot Plus PCs provides a steady countertrend. Wall Street focuses heavily on near-term valuation multiples, but international regulatory friction remains the real structural boundary governing top-line growth. ARM reported earnings per share of $0.60, beating the Wall Street estimate of $0.59 by 2.1%, a solid beat that signals strong execution. ARM IP licensing is trading below its 20-day average at 200. An analysis of ARM's official narrative against hard capital flows reveals a growing gap between corporate PR and insider positioning ahead of earnings. Evaluating the data shows net insider selling, elevated short volume, and escalating R&D intensity relative to revenue. Management and financial headlines continue pushing the narrative that ARM is essential for AI rack-scale platforms. But while retail investors buy into the story, executives are quietly taking money off the table. Over the past 90 days, corporate insiders net sold 216,049 shares ahead of earnings release. No qualifying executive statement in the last 6 months appears in official filings to justify the current valuation. Meanwhile, short seller flow, the daily percentage of trading volume marked by bearish bets, spiked to 66.5% against a 55.7% baseline. Wall Street is selling the narrative to retail while quietly positioning for a valuation contraction. Looking at the fundamentals, ARM delivered a modest EPS, earnings per share, the quarter's net profit divided by common stock, beat of 2.1% at 60 cents per share. But sustaining that growth requires massive capital. R&D, research and development, the direct cash spending on next-generation chip architecture, surged 34% year-over-year to a substantial amount, soaking up 56.4% of total revenue. What management frames as AI platform dominance, the lab reads as an increasingly expensive engineering treadmill with narrowing margins. Watch the R&D to revenue ratio in the upcoming filing. If R&D exceeds a certain threshold of revenue without accelerating royalty growth, the bull thesis breaks. The momentum breakdown for ARM. RSI sits at 32, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. ARM's royalty engine already outpaces China's loss, not despite it. Hyperscalers are integrating custom ARM9 silicon into server architectures, while turnkey Neoverse subsystems pairing HBM3E deliver superior performance per watt efficiency. Expanding royalty rates across flagship AI smartphones and Copilot Plus PCs insulate foundational revenues across multiple tech hardware cycles. The lab sees architectural leverage turning geopolitical headwinds into tailwinds. However, elevated short interest at 12% of float reflects real operational friction. U.S. export controls permanently eliminate licensing high-end Neoverse cores to major Chinese enterprise buyers. Ongoing litigation with Qualcomm over NVIDIA licensing terms threatens royalty structures. The lab sees structural pressure building on the royalty model. What is the core question institutional investors must ask management on an upcoming date? The critical metric is whether ARM9 royalty rate expansion can offset direct revenue loss from restricted Chinese markets and potential contract renegotiations. If ARM9 licensing growth exceeds 25% of total revenue, architectural dominance nullifies geopolitical licensing restrictions. The lab sees a clear tipping point for IP pricing power. If ARM9 adoption slows while Qualcomm legal disputes pressure licensing yields, it signals genuine erosion in core IP pricing power. Based on structural ecosystem stickiness and enterprise server expansion, the lab assigns ARM a Moat durability score of 88. Confirming exceptional long-term competitive durability despite short-term earnings noise. The lab sees durability intact unless the tipping point fails. What ARM is saying, royalty growth will offset China loss. What the lab hears, only if ARM9 exceeds 25% of revenue does that hold. The case against this thesis, ARM9 licensing growth stays below 25% of total revenue. Here's the macro picture shaping ARM. U.S. Commerce Department export controls severely restrict ARM from licensing high-performance Neoverse V2 and V3 CPU cores to Chinese customers like Alibaba. Meanwhile, geographic concentration at TSMC leaves key licensees like NVIDIA, Qualcomm, and Apple vulnerable to cross-strait geopolitical instability in Taiwan. Hyperscalers are replacing x86 architectures with custom ARM9 silicon to host AI accelerator offloads and optimize performance per watt in data centers. This momentum is accelerated by turnkey Neoverse compute subsystems integrated alongside NVLink and HBM3E in flagship chips like NVIDIA's GB200 Grace Blackwell superchip. Near-term upside stems from rapid royalty rate expansion as ARM9 adoption grows across AI PCs and smartphones like the Apple iPhone 16 and Copilot Plus PCs. Conversely, the single biggest risk is an adverse ruling or margin squeeze from the ongoing legal feud with Qualcomm over NVIDIA architecture licensing terms. Qualcomm dropped 2.4%. Its Moat scores 63 out of 100. Durable. Mainstream financial analysts completely miss how fused Hexagon tensor accelerators enable low-power SoCs to capture 15 million projected AI PC reference units. This hardware integration creates a massive structural advantage beyond standard mobile narratives. Our full teardown reveals whether on-device generative AI provides Qualcomm true long-term pricing power. What operating evidence matters most for Qualcomm Incorporated? Qualcomm's durable Moat isn't just about edge dominance. It's the Hexagon tensor accelerator fused into low-power SoCs that lets it grab on-device generative AI across 15 million projected AI PC reference units. And another question, what could weaken Qualcomm Incorporated's Moat durability? Execution risks loom. US. Qualcomm's EPS beat, $2.65, up 1.4%, yet the stock fell. If you look away now, you'll miss why this beat matters for mobile chip demand. Wall Street sold the news despite the beat, shifting capital from consumer mobile to pure-play hardware infrastructure. Qualcomm lags its sector benchmark over the past 30 days. Market rotation hurts Qualcomm short-term. The underlying hardware explains the disconnect. Competitors use custom silicon on massive die sizes at high TDP, while Qualcomm keeps on-device processing inside a 1-watt envelope. Power efficiency is Qualcomm's real edge. This architecture proves Qualcomm's mobile and low-power Moat stays intact despite near-term market moves. The Moat isn't broken, it's just overlooked. Quarterly financials showing modest revenue momentum for Qualcomm. Qualcomm's Snapdragon 8 Gen 3 ban on Huawei is reshaping its revenue mix, while CHIPS Act funds push domestic fab expansion. Capital in the semiconductor supply chain is rotating away from wireless mobility, with ARM and NXPI down last Friday. The Federal Reserve's benchmark rate at 3.63% and the 10-year Treasury yield at 4.71% force chip designers to justify higher R&D spend against rising financing costs. Prediction markets price a 6.9% recession probability, while normalizing yield curves signal tighter liquidity across hardware supply chains. Punch, rates and markets squeeze chip budgets. Strict export controls on Qualcomm's Snapdragon 8 Gen 3 processor and X75G modem for Huawei shipments have disrupted sales channels, shifting volume to Samsung and Apple in unrestricted regions. CHIPS Act incentives subsidize Qualcomm's domestic fab expansion, while Taiwan Strait tensions move RF front-end assembly away from TSMC. AI sentiment is shifting from software hype to physical energy limits and supply sovereignty. Management's guidance frames domestic fab transition as a hedge against overseas mobile revenue friction. Punch, export controls and CHIPS Act reshape Qualcomm's geography. The core takeaway, Qualcomm's revenue mix is being redrawn by policy, not just cycles. Qualcomm reported earnings per share of $2.65, beating the Wall Street estimate of $2.61 by 1.4%. A solid beat that signals strong execution. Qualcomm is trading below its 20-day average, currently at 166. Qualcomm's management opens their earnings narrative with guidance, reflecting solid execution as we navigate a challenging memory environment. Cristiano Amon, President and CEO, Q2 2026 earnings release, April 2026. That is classic corporate language designed to focus attention on operational discipline while glossing over a 3% year-over-year revenue decline. While corporate press releases emphasize AI expansion and upcoming custom silicon, company insiders net sold 31,529 shares over the past 90 days leading into their July earnings report. Wall Street reads a diversification narrative. The insider transactions signal key executives taking capital off the table while mobile handset growth remains constrained. Insider selling shows doubt despite the AI story. Look past non-GAAP EPS, non-GAAP earnings per share, an adjusted profitability metric that excludes one-time accounting items, of $2.65, which edged past estimates by 1.4%. Qualcomm invested $9.0 billion into R&D, research and development, the direct capital allocation required to design next-generation silicon architecture, holding at 20.4% of revenue. However, with R&D spending rising only modestly year-over-year, non-GAAP net income dropped 10%. Management shifted from aggressive expansion phrasing to defensive margin messaging as underlying chip volume flattened. What management is saying, solid execution. What the lab hears, revenue stagnation masked by cost cuts. On July, watch R&D as a percentage of revenue. If it drops below 20%, pipeline conviction is failing. Note, the final output must contain only the edited narration. The analysis above is for internal reasoning and should not be included in the returned answer. The momentum breakdown for Qualcomm. RSI sits at 30, pointing to oversold territory, potentially setting up a bounce. MACD is currently bearish, with downward histogram pressure. Qualcomm's durable Moat isn't just about edge dominance. It's the Hexagon tensor accelerator fused into low-power SoCs that lets it grab on-device generative AI across 15 million projected AI PC reference units. Execution risks loom. U.S. export controls on advanced RF front-ends threaten Chinese OEM revenue, and 13F institutional data shows legacy positioning from holders like BlackRock that does not reflect real-time distribution pressure. What is the critical hardware question Wall Street misses? It is whether Qualcomm can keep target wafer yields on advanced packaging nodes while shifting assembly from TSMC to domestic fabs without margin compression. The lab's answer: packaging transition friction will temporarily weigh on margins before volume scale normalizes output. What Qualcomm is saying: strong AI PC pipeline. What the lab hears: margin pressure from packaging shift. The lab's priority watch is Qualcomm, where a Moat durability score of 63 measures core business strength. If Qualcomm ramps Snapdragon X Elite shipments into flagship handsets, it validates on-device AI market expansion. If export restrictions widen across Chinese mobile partners, it signals structural market share loss. The case against this thesis: a sustained drop in wafer yield below target levels during the packaging shift. Here's the macro picture shaping Qualcomm. The Biden administration's export control rules placed Snapdragon 8 Gen 3 and X75G modem on the entity list for shipments to Huawei, forcing Qualcomm to re-engineer supply chains for its flagship mobile SoCs and shift volume to Samsung and Apple in other regions. Simultaneously, the CHIPS Act's $52 billion incentives accelerate QCOM's U.S. fab expansion, while rising Taiwan Strait tensions push the company to diversify its RF front-end assembly away from TSMC to onshore partners. The industry is coalescing around heterogeneous AI acceleration and advanced 2.5D/3D packaging, and QCOM's latest Snapdragon X Elite and QCM 6490 SoCs embed a dedicated Hexagon tensor accelerator paired with HBM2E via its Infunders OS package to meet on-device generative AI workloads. This trajectory is extending into automotive, where the new Qualcomm SmartSight platform leverages the same AI-first architecture to deliver real-time perception at 60 frames per second. The single biggest upside in the coming 3-6 months is the ramp of Snapdragon X Elite-powered flagship phones and the first commercial shipments of Qualcomm's AI PC reference design, which could lift QCOM's revenue guidance by up to 7% if OEM adoption meets the projected 15 million units. Conversely, the greatest downside risk is a sudden tightening of U.S. export controls on advanced RF front ends to Chinese OEMs, which would curtail QCOM's 5G modem sales and could shave 5% off the same period earnings. NXPI semiconductors fell 2.9%. Moat 76, high durability. What operating evidence matters most for NXPI semiconductors envy? NXPI's S32 architecture isn't just another auto chip. It's the core compute layer locked into steering, braking, and powertrain ECUs. And another question: what could weaken NXPI semiconductors envy's Moat durability? Punch: China pressure erodes utilization. The market is aggressively pricing in execution risk across the automotive semiconductor space, causing capital to rotate out of analog chip makers before earnings numbers hit the tape. Wall Street wants to know if high channel inventory will crush near-term operating margins. The physical reality behind this earnings setup comes down to fab utilization rates, the percentage of semiconductor manufacturing capacity currently running active production wafers. NXP relies heavily on internal 28-nanometer planar process nodes, manufacturing technology generations that define chip transistor density, which face utilization drops as automotive Tier 1 suppliers burn through existing component stock. If wafer production falls below a certain threshold, gross margin guidance will deteriorate regardless of edge computing demand. Quarterly financials showing modest revenue momentum for NXP. Here's what the numbers actually say. NXP's earnings face pressure from rising borrowing costs and shifting capital within the technology supply chain. The Federal Reserve's benchmark rate sitting at 3.63% has elevated capital expenses for automotive customers, curbing near-term vehicle production lines and chip ordering rates. Third-party prediction markets currently place the U.S. recession risk, the probability of an economic contraction, at a notable level, reflecting broader macroeconomic stabilization. Rising rates squeeze auto chip demand. Geopolitical frictions directly impact NXP's core operational distribution. U.S. export controls on advanced tech in China directly threaten NXP's revenue from Chinese EV makers like BYD. Potential new tariffs on foreign packaged analog semiconductors threaten to compress gross margins across international distribution networks. Wall Street analysts maintain a cautious tone on automotive semiconductor exposure as consumer vehicle demand cools. Management's prepared remarks will signal whether Chinese localized sourcing can offset rising trade barriers and cooling North American auto sales across the upcoming fiscal quarters. Export controls threaten revenue. NXP Semiconductors reported earnings per share of $3.05, beating the Wall Street estimate of $3.01 by 1.4%. A solid beat that signals strong execution. NXP Semiconductors is trading below its 20-day average, currently at 2. The narrative isn't accelerating growth. It's a thin veneer over flatlining R&D. Management's headline entering Q2 earnings is broad-based improvement across all of our focus end markets, framing their software-defined vehicle and edge AI push as an accelerating growth driver. The momentum we have built is expected to accelerate through the remainder of 2026. Rafael Sotomayor, President and Chief Executive Officer, NXP Semiconductors, Q1 2026 earnings release, April 2026. While PR spins a narrative of expanding adoption, insiders net sold 2,746 shares over the past 90 days. What NXP is saying, broad momentum across end markets. What the lab hears, insider cash out contradicts the story. The lab decodes what management is actually hiding behind those hedge phrases. NXP barely scraped past Wall Street expectations with an EPS, earnings per share, a company's net profit divided by its outstanding stock, beat of just 1.4%, delivering $3.05 against $3.01 estimates. Meanwhile, R&D, research and development, the capital allocated to engineering future product architectures, expanded just slightly year-over-year to 19.2% of revenue, showing stagnant structural reinvestment into next-generation processing nodes. What management calls broad momentum, the lab sees as flatlining innovation velocity. When NXP files its 10Q report, ignore the headline revenue and check R&D spending. R&D under 19% of revenue means the software-defined vehicle moat is broken. The momentum breakdown for NXP Semiconductors. RSI sits at 43, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. NXP's S32 architecture isn't just another auto chip. It's the core compute layer locked into steering, braking, and powertrain ECUs. The deep integration creates switching costs that bind Tier 1 suppliers once a design win reaches production. Punch, architecture drives lock-in. Physical limits on legacy packaging lines and aggressive China-based substitution threaten that moat. A large share of revenue sits in Chinese auto markets where local firms undercut NXP on standard MCUs. Slow inventory absorption at Tier 1 suppliers presses near-term factory utilization. Punch, China pressure erodes utilization. What specific utilization rate on legacy 28nm lines is required to keep gross margins above 50% if China revenue falls 5 points? The lab's analysis shows that unless NXP holds fab utilization above the break-even threshold, fixed overhead drags operating margins regardless of edge AI growth. Punch. Utilization dictates margins. If NXP posts sequential S32 revenue growth while July auto inventory stabilizes, it proves architectural lock-in outweighs regional frictions. If guidance shows contracting gross margins from lower utilization, it signals accelerating China share loss. Punch. Growth or margin contraction tells the story. What NXP is saying: architectural moat shields China risk. What the lab hears: utilization, not architecture, decides moat durability. The lab assigns NXP a moat durability score of 76, marking its priority focus on fab utilization metric durability. Punch. Score hinges on fab use. The case against this thesis: NXP's 28-nanometer fab utilization drops below the break-even level. Here's the macro picture shaping NXP semiconductors. Tightening USBS export controls on China directly pressure NXP, which derives over 30% of its revenue from Chinese automotive customers like BYD. Although CHIPS Act funding aids domestic fab expansions, new U.S. tariffs on foreign packaged analog chips threaten near-term margins. The migration towards software-defined vehicles and localized edge AI is accelerating demand for NXP's heterogeneous processing platforms and automotive radar transceivers. NXP is capitalizing on this transition by scaling its flagship S32 automotive compute family alongside. ARM's durability score of 88 is the only number that matters. Which operating metric best separates ARM from Qualcomm? Comment your reasoning. This isn't financial advice, just engineering-level analysis. Markets change, data shifts, and past performance never guarantees future results. Always run your own numbers before pulling the trigger. Hit subscribe so you don't miss the next deep dive. We go die level on every stock. If you want our full breakdown on NVIDIA, the link is in the description. Stay sharp in the lab.